All right, let's talk about something huge for any growing business. You need that big piece of equipment to level up, but how in the world do you pay for it? Well, today we're going to demystify heavy equipment financing, breaking it all down so you can make a super smart choice for your company's future.
So, picture this. You just landed that huge contract. Congrats, by the way. Where maybe, just maybe, that trusty old bulldozer is finally giving up the ghost. You know the deal. To grow, to really take that next big step, you need a new piece of heavy iron. It's just a fact of life in your business.
And then you see the price tag. Oof, we are talking six figures easily, and often way, way more. I mean, that's a number that'll make anyone, even the most seasoned business owner, take a very deep breath.
Right? Because that kind of cash isn't just sitting around in a checking account collecting dust. That's your operating capital. It's the money you need for payroll, for supplies, for all the day-to-day stuff that actually keeps the lights on and your business running.
And this is exactly why almost everybody finances. You might think, oh, financing is for companies that are short on cash. Nope, not at all. Get this. According to the Equipment Leasing and Finance Association, a whopping 80% of U.S. businesses finance their equipment. It's not about being short on cash, it's about being smart with your cash. It is the smart way to grow, and we're going to break down exactly why.
Okay, so you're going to be part of that 80%. Great. But right out of the gate, you've got a massive choice to make. And trust me, this isn't a small one. It's a decision that's going to affect your monthly payments, your taxes, and really the whole financial future of your company. And really, it all comes down to one core question. What's your goal? Are you trying to build ownership and add a big asset to your company's books? Or is it all about flexibility, keeping cash on hand and being able to upgrade to the latest and greatest gear whenever you need to? So let's break this down. The table here shows all the nitty-gritty differences, but here's the bottom line. Think about it like this. If you're an established company and you know for a fact you'll be using that backhoe for the next 10 plus years, a loan is a total no-brainer. You're building an asset. But let's say you're a newer contractor and you just need a skid steer for this 1-2 year project. In that case, a lease is probably your best bet. The payments are lower and you're not locked into that machine forever. It's all about adapting.
So this is the question you gotta ask yourself, plain and simple. Am I buying a long-term asset for my company, or am I basically just renting a tool that I need to make money right now? Your honest answer to that question is gonna point you in exactly the right direction.
Okay, so you've picked a path, loan or lease. Awesome. Now, let's flip the script for a second. Let's put ourselves in the lender's shoes. What are they actually looking at when they're deciding whether to say yes or no? It's not some big mystery. Lenders are just trying to get a clear picture of your business's financial health, and they do it by looking at four main things. Number one, your credit score, both personal and business. Number two, how long you've been in business. 2 years is kind of the magic number. 3, your revenue and cash flow. They want to see that money is coming in consistently. And 4, a down payment. They want to see you've got some skin in the game. If you can check these 4 boxes, you are golden.
All right, let's get to the part everybody really cares about, the money. We're gonna talk about the costs and sneaky fees you need to watch out for, but then we'll get to the good stuff, the amazing tax perks that can literally save you a ton of cash.
Seriously, before you sign on that dotted line, you have to be a bit of a detective. Ask about all the fees. What are the origination fees, the documentation fees? Are there penalties if I want to pay it off early? Don't be shy about it. Ask them straight up, what is this for? Can we do anything about it? The more you know, the more power you have in the negotiation.
But okay, now for the really, really good part. I want you to meet your new best friend, and its name is Section 179. This thing is part of the U.S. tax code, and it is a total game changer. We're not talking about a small deduction here. This is a seriously powerful tool that can slash the real cost of that equipment you're buying.
And here's the best thing about it. It's super flexible. This massive tax break works for both brand new and used equipment. The only rule is that it has to be new to you. So think about that. You can find a great deal on a slightly used machine and still get to write off the entire purchase price. How cool is that?
Let's put some real numbers to this so you can see what I mean. Let's say you buy a piece of equipment for $250,000. With Section 179, assuming a 21% tax rate, you could save $52,500. That's not just a little bit of money. That's a brand new work truck. That's an entire employee's salary for a year. It's real money that goes right back into your pocket, right back into your business.
So there you have it. You're armed with all this info now. You know the difference between a loan and a lease, you know what lenders are looking for, and you know about the awesome tax perks.
Now, it's time to actually make your move.
Here's your game plan. Super simple, just 3 steps. First, get your paperwork together. Have your recent tax returns and bank statements ready to go. Second, don't just take the first offer you get. Shop around. Talk to at least 3 to 5 different lenders. Your local bank, a big national one, a company that only does equipment financing. And third, figure out your real cost. Don't get fixated on just the monthly payment. You have to add in all those fees we talked about, and then, this is the big one, subtract the tax savings you're going to get.
Look, at the end of the day, financing a piece of heavy equipment isn't really about the machine itself. It's about investing in your own future. It's about getting the tools you need to grow, to build something bigger, better, more profitable. So the only question left is, what are you going to build next?